Welcome back. You're tuned in to Editor's Roundtable. Well, let's focus on the big focal point then. The equity mutual funds are sitting on solid ammunition, and the cash levels that they're sitting on is actually the highest we've ever seen. So the cash market levels in percentage terms, as a percentage of the total equity AUM, is at around 7%. Just take a look at the way it's moved up. From around 5.5%, it's gradually moving up. Now at around 7%, if you look at it in absolute terms, it's around 2.15 lakh crore. Remember, we're talking about the core equity AUM out here. The cash levels are around 2.15 lakh. So it makes sense to pull up some of those, mutual funds that are sitting on a good amount of cash. SBI, well, they are sitting on close to around 36,000 crores. PPFAS on a base of less than a lakh, they're at around, 24,000 crores or thereabouts. Around a lakh is what their AUM is. ICICI Prudential at around 28,000 crores, and HDFC Mutual Fund, they are as well at around 25,500 crores. But it makes sense to look at the cash levels that they're sitting on, and if you compare it with the total equity AUM, and that number comes up for you in the screen. So just take a look at PPFAS. They're sitting on cash, plenty of cash, a lot of firepower available with them. Similar is the case with Motilal Oswal Mutual Fund, Quant Mutual Fund, as well as SBI and Axis Mutual Fund. So all of them sitting on a good amount of money. Now, the question is, why are these equity mutual funds sitting on a lot of cash? Three possible reasons. One is that in case of times of uncertainty, you want to have some kind of liquidity, some kind of ammunition in your hand. So that could be one point. Now, the question is, will they be forced to rush in? Because now the macros are improving. You look at the Indian rupee, you look at the crude oil prices that have come out as well. FI flows have been gradually coming in there, and the RBI, they have managed things very, very well, both on the liquidity front as well as the rate cuts that the market is anticipating. The problem is that there could be a bit of a negative, and that's why they're sounding a little bit cautious and they're sitting on this cash. Because of what we were discussing, right? The supply overhang. OFS, there are lock-ins that could come off as well, and you could see some kind of supply that's coming in there. So are they signaling something, or are they going to be forced to rush in? Equity mutual funds sitting on cash of close to around 2.15 lakh crore. Well, Gautam, I wanted to ask you, we briefly discussed this as well in terms of the cash levels, but tell us how you're reading earnings, because ultimately earnings are what drive this market, right? And Q4 wasn't expected to be good, but the street was looking forward to commentary for the coming quarters. Are you satisfied?
So I think it's a question of expectations more than absolutes. So the expectations are still not optimistic in general. People are expecting second half recovery. Yeah, exactly. That's what happened in the 4Q till now. The expectations were running very, very low.
In that context, the numbers are better?
Marginally. Marginally. Again, a mixed bag as always.
But at a house level, are you expecting some upgrades after the Q4 earnings?
So our strategist believes that double-digit earnings growth, which is being talked about in the market for the full year fiscal 26, is reasonably likely. Having said that, I think given the way the policy easing cycle has happened or is happening, that's still not played out completely. Will there be a room for that? Every year we talk about 15% growth and the numbers
the negative
down.
Surprises. Will we have positive earning surprises?
At least it's much more going to be closer to expectation, if not beating the cycle. Because I think the market is still not completely, including strategists and analysts, in my view, building in completely the effect of easing cycle. And we are seeing meaningful easing cycle, both RBI and central government. Again, one last thing to remember there, over this year and next year, fiscal 26 and 27, we'll see 2% of GDP consumer stimulus. 2% of GDP from the social welfare schemes, the pay commission, and the tax break, which is meaningful. It's meaningful. So at a bigger picture level, one of the simple calls the strategists are making, which we believe in, is this is the next year or two, consumption as an overall theme should do much, much better than they have in the last couple of years.
So let's narrow down a little bit more, right? What do you like from the consumption basket?
So we like everything, from staples to discretionary to leisure to hotels, everything. But obviously within that, the aviation / leisure / hotels, they are better placed. For sure.
And they bounce back big time as well in this week.
But they can do.
One sector, my home sector, so to call it, like have you have a home ground? Cement is a sector that I've been trying.
Home or
Friday evening.
Metal,
I'm surprised to see
and the other stuff.
cement as your...
Okay, let's give you an option then. Both my favorite sectors. One is the cement one, which, I track very closely. And the other one is where I contribute.
Contribute very closely.
As a consumer.
Cement had a very, very rough last year. But now things are looking up. Pricing are moving up, demand is better, and input costs are down. And the other one where there is an immense consumption boost and immense scope out there is alcohol beverages. Which one do you like?
Alcohol beverage, we have to also look at the FTA impact. We'll see how that plays out. It's still early in the day. So I think the answer is very clearly towards cement.
Okay.
Cement, both from the input cost, demand surprise possibility, and also I think the housing cycle is still, in our view, underappreciated. So that has much more, not just the real estate is one part of it, but the broader housing, government spending on housing, for example, that has more legs than is being built in our view.
Sure.
Okay,
So, but just one more question on the cement pack. Would you go with these larger names? I'll tell you why. Because when times are a little bit dull, then people like to hide in the larger names. But when the cycle is going to turn, for example, a couple of these south-based cement companies came out with below expected numbers or weak numbers as well. But those stocks are up because the street is saying going ahead is going to improve, and then that buzz about M&A and all that. So what would you like?
So typically, that's what happens. The smaller ones do well. We don't have coverage of the small cement names, but yeah, that's where the operating leverage is more. But even on the large cap, I think it's not been a case where a large part of the large caps are trading at very rich valuations.
Yeah.
There are pockets there which are very well placed, very attractive, even from a valuation perspective. So our preference is risk-reward wise still the large caps, but obviously, if you have the risk appetite, then go down.
So,
Gautam, we spoke a lot about the domestic triggers and the earnings and everything. What about the global setup? Are we just forgetting that what's happening in the US, what's going to happen with the tariffs, is something still a serious concern which one should watch out for?
It is an overhang for sure, which we have, I think, pushed it out a bit, waiting for the next tweets or whatever. But again, look, the one good respite in general, where I think the global economy and investor class is getting some comfort, is ultimately we did see a pullback on the tariffs on China, and a sharp one. It's not going from 145 to 60 or 80. It's a sharp pullback, which in a way tells us, okay, the tariff is a new reality. US will have tariffs. Possibly, even you look at the US-UK FTA, you have 10% in general. So 10% will be a tariff. So the weighted average tariff from US on the economy globally will still be higher than it used to be last year in any scenario, and which will be therefore a drag on growth, at least in the near term. But at least it may not be as extreme as 2 months back. So there is some respite. But uncertainty and overhang, absolutely. We still don't even know.
What's the UBS US house view in terms of recession, in terms of growth? What's your big call?
So there is a reasonable chance of recession, but again, short-lived, not a long-lived one, for a quarter or two. Reasonable probability, that's not necessarily the base case. The base case is maybe for a quarter, but not sustained recession.
But will that be disruptive for emerging markets like India?
So question is, recession is a one data print, right? Sure. Yeah, but that data print happening in the context of the overall tariff and direction of that, then market might just look through that.
Ignore it. Okay.
Yeah. But if it's a broad-based tariff disruption, again, I think the bigger issue now, given what's happened in the last 3 months, is uncertainty rather than the level of tariffs. The level of the tariffs, people are less shocked today, about 20-30% than they were 3 months back.
I think that's how you play it, right? When you say 145, 30 looks absolutly fine. You know,
That is also not small, right?
that is very small.
Uncertainty is the thing.
Yeah, so it's like our earnings. You know, we were so much low in terms of expectations.
So, 6-7%, volume growth of 5% on an FMCG company, it's like, wow.
If you look at the global thing, US, China, at least we have some sense of next 2-3 months something will happen.
Yeah.
UK is already done. Europe is the missing piece, but again, UK, China template will get done. India, anyway, we are hoping that will get done soon. So I think large part of the economy will have uncertainty behind us in the next couple of months.
In the near term,
Surbi, just to wait, it's like you used to coming home at 2-3 a.m. in the morning after a good party night. You come at midnight, it's a lottery.
it's like early.
Mom will be surprised.
Yeah, parents can't believe it.
Why will be surprised what happened?
But you're
Something like that. It's all about expectations, right? And the reset therein. Gautam, since we're talking global, I'm just curious, what are the conversations that you hear or pick up on when it comes to foreign money and foreign clients? Because as this thaw continues between US and China, I was always watching out for the days the Chinese market was rallying, because we know that in the valuation context, China's much cheaper, right? And you also have the, a lot of the tech plays, which are very high-tech sort of plays, which you don't have here in India, bigger-sized businesses. And the world has largely ignored all that. The Chinese market has been in the doldrums. So is the China revival, a tactical revival maybe, in equities, could that be a risk for India in the near term?
You mean more from a flow perspective?
From a flow perspective, yeah.
Yes and no. Like, I think in general, if China revives, it's actually great for EM as an asset class.
Yeah, correct.
So India
Because the
actually
EM basket does
And
well.
everybody will get the money.
And the second part, unlike last year, India's positioning for global and EM investors is not that heavy.
Sure.
It's still neutral, underweight, depending on how you look at it. It's not that investors have gone overweight India in a material way, unlike, say, a couple of years back or a year and a half back. So the positioning is also not, I won't worry about that aspect. I think it will be good because China recovery means EM asset class. China recovery also means good global growth.
Yeah.
It's actually
So
good.
overall, it'll be good. Got that point. So I'm going back to now what you like. Just to recap, you spoke about cement, which is something that you like. Capital market plays, we spoke about that. What else? I mean, house view. What is the biggest bullish?
Yeah.
Consumption is the biggest one,
Consumption.
as a simple thematic, specifically given how investors are positioned, priced in, what they have done in the last couple of years. So that's the obvious big bet for us. Financials remain a big bet, and then real estate.
I want to ask you on defense. We've seen a big recovery in the defense stocks. Then some of the defense, schemes, mutual fund schemes, the NAVs have moved up sharply from 15, a low of 15 to now 23. Do you think it's a decadal opportunity, the way we've shown up our strength and the Indianization which is happening? Do you think defense could be a big play from here as a thematic play?
Yeah, so the policy environment suggests that policy environment, despite the fiscal constraints India has, just the localization should be a big driver. This thing always difficult. It's easy to say 10-year themes, but always difficult. But again, we've seen what happened to defense in Europe also.
True.
But the difference here and Europe is looking at increasing spending structurally.
Yeah.
That's not the case in India necessarily, given the fiscal constraints. But within that, a much more higher localization. Again, early signs suggest it could continue for long. Sure. That's what the markets are already possibly pricing in.
Yeah.
Our analyst remains bullish.
Okay. You'll have a bullish house view on the
defense.
Okay, so market, let's say 6 months from now, by the year end?
Unlikely to be down.
Okay. That's a good way to put
Unlikely
it.
to be
Good
down.
enough.
Okay.
But do you make higher than risk-free returns? That's a tricky one to answer right now.
Okay. Well said, well put, Gautam. Thank you very much. Great conversation. Thanks so much for dropping by. And we look forward to more of these in perhaps the coming Fridays as well. Thank you.
Thank you.
Well, with that, guys, it's curtains. It's time to say goodbye. I guess it's a wrap on this edition of Editors Roundtable then. Thank you very much for watching. News and updates continue right here on CNBC-TV18.